Hello and welcome to another video. In this video, I'm going to show you a more unorthodox method of trading mean reversion trading strategies. And as always, I'm going to show you a backtest report with data of over 12 years worth of trades. If you've seen any of my previous videos, you'll know that I always back up my strategies or always back up what I say and my developments with actual data. So I'm not second guessing things, and I'm not choosing select periods of time where a strategy happened to work well for 6 months and then not work well at all for the rest of the time. So you're going to see everything from the 12 years worth of trades on the computer a little bit later on. So firstly, those of you who don't know what mean reversion trading is, I'm going to use my whiteboard to try and demonstrate how mean reversion works and how we can benefit from it. Now, I mentioned that the method that I'm going to show you is unorthodox, and what I mean by that is most of the time when people are trading mean reversion, they'll use indicators that they apply to the charts. They might use RSI, Williams percent R, Stochastics, and that will determine whether the price is overstretched to the upside or to the downside. But I'm going to show you a different way of using no indicators whatsoever. Imagine that this is a price chart. I've pretty roughly drawn one out, and you know what the bars are. I'm going to show you a 30-minute chart, but they could be any time frame. And this centre line, imagine that's a moving average, let's say a 20-period moving average. Now prices, as you know, they move up and down, and they might move up above the moving average, come back down below the moving average, and the moving average is often called the mean, so it's the mean or the average, and that's where mean reversion gets its name from. So mean reversion trading involves identifying when prices are overstretched, either to the upside, as in the distance that the prices are in comparison to that mean or that moving average, or to the downside, so how much below they are to the moving average, because eventually what happens is they might get stretched up, but then they do come back to the average, and then they might go down, or they might actually stay at the average and then go back up, but prices are constantly stretching away from that mean and then back to that mean. And our job, if we want to trade mean reversion, is to identify when the price is just about fully stretched and when it's just about to turn back, because then what we can do is, if we know it's overstretched to the upside, we know for around about here there's a good short sell opportunity. It's a good time to get in short and make money to the downside. And of course the opposite is true. When the prices come and stretch right below the mean, then that's quite often a good time to buy and go long to catch an upside move. I'm going to quickly rub this off, and then I'm going to do another little drawing and show you that the method, I'll show you how the method works that I'm just about to show you on the whiteboard before we then look at the trading software on the computer and look at the results. We've established then our job as mean reversion traders is finding when prices are at extreme levels, extreme highs or extreme lows, so that we can trade against them and trade looking to catch moves going back towards the mean. A common method, I've already said, to identify these extreme levels is to use indicators, looking at extreme highs and extreme lows in the indicator itself. But today we're not going to do that. We're going to look at the method I'm about to show you here, because I generally don't use indicators in my trading strategies. And I believe that doing something that the masses aren't doing, the masses typically are using indicators. I believe doing the opposite of that and finding different methods to identify, in this example, overbought and oversold levels does actually give you an edge, which is what trading is all about. I have the price bars drawn up on the board again, and I mentioned in the example we're going to look at is 30-minute chart, pound-dollar, forex pair. Now what we're looking at is the closing prices. That's pretty much all we're paying attention to, is the closing price. So if you look at bar charts like this, or you might look at candlestick charts, we're looking at the right hand dash here, which is obviously the close. Now what we're looking for is the highest close over the past 6 days, or 6 bars as it were in this case, and we're also looking for the lowest close over the last 6 bars. So here's a short sell example. we've seen this bar close here, and what we do is we look back over 6 bars to see if that's the highest. So here's the close, here's the close, here's close, yeah. So over the past 6 bars, this close here is the highest. So that's our trigger to enter short. Remember, we're looking for extreme up moves, and then we're betting against them. So now we would short sell, hoping that the price is going to do something like this and then eventually move down and make us some money. That's it. It's that simple. And of course, the opposite for buy trades. We're looking for the lowest closing price over the last 6 bars, and then that's our signal to enter the market. And we literally just enter at the open of the next bar, which is normally immediately when we trade in 30-minute bars with Forex. And don't get confused with the highs and the lows of the bars. We're looking at the closing prices, okay? Let's now have a look at the computer, where I'll show you how it looks on the charts and the backtest report from over 12 years worth of trades. In this first workspace, we can see all the trades on the chart, and because we've got no indicators or anything, it doesn't mean a lot, does it? But let's have a quick look at the performance report. And here's what the equity curve looks like, trading from 2008 through to 2020. And what we can see is a really nice, smooth, uniform, uptrending equity curve. And essentially what that's telling us is the behaviour of the market has stayed the same throughout all these years. So short selling those 6 bar highs and buying those 6 bar lows has worked throughout the whole period of this test, which is really, really good. The behaviour of the market is still there. Now, I think I mentioned earlier that we were looking at 30-minute charts, and I apologise, I was wrong. I meant a 15-minute chart we can see here. I wanted to see if I could improve this strategy as well. So what we look at in the next workspace here, we can see we've got fewer trades straight away. What I looked at, is there a particular time of the day where taking these signals or trading actually works better than others? And I found out there was. So in this particular workspace, we're looking at trading only between 1400 hours and 1900 hours, which is Eastern Standard Time. Just found that the trades were just better quality trades and things just work better. So let's have a look at the equity curve, and we can see actually we've got an even nicer looking equity curve. And let's have a look at the annual analysis, so we can see year by year how the market has behaved. And we can see, look, every year is a positive year. So this behaviour is really even throughout that time. However, unfortunately, we can't just trade this as is, because the average trade value is just too small. If we have a quick look, we've only got an average trade value of $42, which isn't bad, but at the time we've taken $20, $30 worth of trading costs out of this, we wouldn't be left with much profit whatsoever. So I've taken it one step further for you and had a look at the price behaviour of the previous day before we take these trades. And what I found is if we've got quite a strong close to the upside on the previous day, then we should be looking to take buy signals, but not short signals, and the opposite. If we've got quite a strong down close on the day before, then we should only be looking to take the short sell signals, not the buy signals. And here's the workspace here. Let's have a look at the performance report. And straight away you can see that our average trade's gone up from $45 to $75. So much stronger. And how has it affected the equity curve? Not that much. We can see from the equity curve we've got fewer trades, but lovely uptrending curve. Each green dot here shows us a new high. So it just proves that the behaviour of this market and this strategy is just responding very well throughout all of those years. If you find this sort of study interesting and helpful, hopefully, please give me the like on the video now and subscribe to the channel if you haven't. Giving it a like really does inspire me to, or motivate me to carry on and record some of my own studies in the market. This is how I study the markets all the time as an algorithmic trader. And by you liking the video, then that inspires me to share it with you. So hopefully you can benefit from my work on the markets too. But that's not a finished or completed strategy, guys. I will continue to do some more work on that because that average trade value is still a bit small to trade. The purpose of the video was to show you how to identify overbought and oversold areas to trade mean reversion, and show you how that's worked on that pound-dollar 15-minute chart really quite nicely. It showed that the behaviour has been there throughout that long period of time. Whether you want to use indicators or use methods like I've shown you there is no best way to trade the market. I've found the best way is to actually find good ways and combine them. That's what really makes up the decent trading portfolio or whole trading system. And as I always say, it's so important to test things to see how they work. You know, I've shown you that on pound-dollar 15-minute chart. If you applied that to, now I'm guessing, euro-dollar 4-hour chart, it wouldn't work. So, you know, one strategy doesn't work across all time frames and all markets. That's why it's so important to test, and it really, then you get a feel for how the markets respond to different techniques. That sort of strategy, by the way, I found works really well on a daily chart of the S&P 500. But for now, that's about it. I hope you've enjoyed this new approach to trading mean reversion, and if you've got any questions, leave them down below. Or if you've got any video requests or video ideas, then leave them down below, because I read all the comments. And don't forget, please like and subscribe. Visit my website, thetransparenttrader.com, and until the next video, this is Jared Goodwin, and thank you.